Hello and welcome back to The Note. You might not think that you need a new acronym for investing in emerging markets. We have enough already, but we do have one for you today which could be very useful indeed. It's the 3 R's, standing for Reform, Resilience and Reasonable Price, and it's the framework used by UBS Wealth Management to analyse whether you should be investing and how much you should be investing in emerging markets in these obviously quite difficult times. With me now to discuss this is the Global Head of Investment for UBS Wealth Management, Mark Haefele. Mark,
Thank you
very much for joining me in London today. Let's start with an example of resilience. Foreign exchange reserves have been increasing very significantly even since the crisis. Why is this important? How does that feed through into an investment decision?
Sure. Well, if you think about these other acronyms that are out there, the Brics, Mint, they're all about baskets of countries. And as you said, this is a framework for understanding the emerging markets as we go forward, because these economies now are diverging in terms of their sources of growth, and they're also diverging in the ways that they respond with their political economies to changes globally. So with the 3 R's, we're looking at things in terms of what should investors focus on. And the first one, resilience, is about FX reserves and the ability to withstand kind of foreign capital shocks or foreign capital flight.
Okay, so the risk of something like what happened to Southeast Asia in 1997 is minimal to non-existent in China with the scale of the reserves they have there.
Exactly. They've got about 4 trillion in FX reserves, which helps them withstand certain crises.
Okay, now let's move on to your reform category. You've got one interesting example comparing Brazil with Mexico. Brazil was obviously very much the investor's darling rather than Mexico for many years. How does reform help you make a decision?
Well, as global investors look to deploy capital, they like to see that the political economy of countries is going in the right direction. And what this chart shows is that interest rates are falling because global investors like the way that reforms in Mexico are proceeding, particularly around energy reform.
Right. Meanwhile, Brazil, somewhat more populist, very much more popular with investors at one point. Can we take the sharp rises we've seen in Selic as examples of unrest or disquiet with the way the politics are going in Brazil?
Yes, that's absolutely part of it.
Okay. Now let's move on to valuation or growth at reasonable price. I think we all know in the current situation why Russia might look quite cheap. I suppose the question is it too cheap? How do you go about valuation? What's your valuation framework for emerging markets?
Well, valuation is always an important metric and a check on these other forces. So when we look at Russia, it is absolutely, over the near term, a very volatile situation. And with political elements involved, no one knows how it's going to resolve itself. But that said, our base case is that over the next 6 months, this crisis will de-escalate. And in that scenario, as you know, Russia is cheap on most metrics. Oil prices remain high, and therefore we think there can be a rebound from these excessively low valuations.
I mean, do you need one of your other R's, reform, to be a catalyst for a significant rebound, or can we just rebound by a de-escalation in the crisis?
Reforms would provide a tailwind, but as you know, in Russia, the concerns about reforms caused the market to trade at low valuations even before this crisis, and then it got cheaper from there.
Okay. Now, you've also got South Korea and China on this list. I mean, China obviously is a fascinating case. Many people are nervous about the credit system there. How do you go about deciding whether to allocate to China?
So right now, we're overweight the developed markets. We're overweight the United States, and we're overweight Europe. But when you're looking internally at emerging markets, we look at things like valuation. In the case of China and South Korea, both are exposed to better global growth that we see this year, and both are exposed to better CapEx expenditures by global corporations. So in this case, we believe as this global growth comes through, these valuations will start to matter again, and potentially these markets can trade higher over 6 to 12 months.
Okay, Mark, thank you very much indeed. In conclusion, I think that does give a very good framework for a very difficult investment decision at the moment. Plainly, it's still in aggregate difficult to be that excited about emerging markets until some of the confusion has died down over the next few months, but there are still plainly opportunities there for disciplined investors.